Statistics, Modeling, and Finance, Chapter 6, Evolution of Financing, page 10, Money and Capital Markets. We identified two kinds of markets, depending on the length of the term of the investments. Money, market, that's highlighted, is defined as the interaction of buyers and sellers who trade short-term money instruments. Short-term typically means 1 year or less, but can be for longer periods. These would include treasury bills, 3 months, 6 months, or 1 year. Treasury notes, 1 to 10 years. Certificates of deposit, up to 7 years. Commercial paper, a corporation's promissory notes. Municipal notes, short-term obligations of local governments. The capital market, that's highlighted, is defined as the interaction of buyers and sellers who trade long-term or intermediate-term money instruments. These are longer than 1 year and include mortgages, bonds, stocks. Appraisers are generally more interested in the capital market, as much of our valuations concern the effect of financing instruments. End of page. Page 11. Sources of capital, 1900 to 1930. There is a lot to cover. Let's step back a little and take a look at the way lending was done in 1900 to about 1930. In 1900, if you wanted to buy a house, you saved up for many years and paid cash. Long-term financing was not available. Perhaps you were fortunate enough to be wealthy or inherited a house. By the 1920s, about the only lending available was a 5 to 7 year balloon mortgage, and most were interest only. There was no amortization and no possibility of equity buildup. Loan to value ratios were usually less than 50%. Many transactions entailed junior financing, with second mortgages being held by a seller. In 1900, the U.S. population was 76 million, and there were approximately 17 million housing units. Only about 45% of the population owned their own home. Today, the population has passed 300 million, and there are about 110 million households. The home ownership rate is around 65%. Much of this change in home ownership came as a result of changes in the availability of financing. Prior to 1930, housing markets were cyclical, and there were no national standards for banking. There were no credit standards and little governmental regulation of banking. There were many small banks and savings and loan institutions that catered to local neighborhoods. The Federal Reserve was created on December 23, 1913, with the signing of the Federal Reserve Act by President Woodrow Wilson. Its purpose was to provide the nation with a safer, more flexible, and more stable monetary and financial system. End of page. Page 12, 1930s. In the Great Depression, following the stock market crash of 1929, 1,300 banks closed. In the economic turmoil that followed, the federal government created the Federal Housing Administration, FHA. In 1934, to encourage home ownership, investors were wary of the future. FHA came along and offered 30-year fixed-rate mortgages and insured them. It went a long way towards calming jittery investors. FHA also introduced the first housing and credit standards for their loans. They also required that the loans be amortized. Also, in the 1930s, government regulation of the banking industry began. Congress passed the Federal Home Loan Bank Act in 1932. This created the Federal Home Loan Bank Board. Its purpose was to provide funds to savings and loan, which means thrift, institutions to make mortgages more affordable. 57 years later, the Financial Institutions Reform, Recovery, and Enforcement Act, the acronym is FIRREA, of 1989, abolished the Federal Home Loan Bank Board and transferred responsibility for oversight of the Federal Home Loan Banks to the Federal Finance Board. FIRREA also allowed all federally insured depository institutions, including commercial banks and credit unions, to join the FHLB system. Today, the 12 banks of the FHLB system are owned by over 8,100 financial institutions and total about $1 trillion in assets. The Federal Deposit Insurance Corporation, FDIC, was created in 1933 as an independent agency of the federal government. In response to the thousands of bank failures that occurred in the 1930s, today it insures deposits in banks up to $250,000. The FDIC receives no congressional appropriations. It is funded by premiums that banks and thrift institutions pay for deposit insurance coverage and from earnings on investments in U.S. Treasury securities. The FDIC directly examines and supervises about 5,250 banks and savings banks, more than half of the institutions in the banking system. The Federal Savings and Loan Insurance Corporation, FSLIC, was created as part of the National Housing Act of 1934 in order to insure deposits and savings and loans. A year after the FDIC was created to insure deposits in commercial banks, it was administered by the Federal Home Loan Bank Board. It too was abolished in 1989 by the FIRREA, which passed responsibility for savings and loan deposit insurance to the Federal Deposit Insurance Corporation. The Depression spawned some other organizations as well. Because of the trauma from the Depression, there was a loss of public trust in financial institutions and related entities. In addition to bank failures, hundreds of thousands of jobs were lost and the construction industry went into a tailspin. Many people lost their jobs and their houses. In late 1929, the National Association of Real Estate Boards, the forerunner of today's National Association, the forerunner of today's National Association of Realtors, introduced a code of ethics for its members who performed appraisals. The Appraisal Institute was formed in 1932 to promote competent appraisals, and its members also subscribed to a code of ethics. These measures helped restore some confidence in real estate investment. Home Owners Loan Corporation, that's highlighted, HOLC, was a federal agency established in 1933 to help stabilize real estate that had depreciated during the Depression. It granted long-term mortgage loans to some 1 million homeowners facing loss of their property. The HOLC was phased out in 1936 by the terms of the Homeowners Loan Act. We also saw the first subsidized housing in the 1930s. Some was through the federal government and some through private organizations. For example, the Chicago Housing Authority was created in 1937. End of page.